Hello and good evening, ladies and gentlemen, and welcome to the season opener for the Kuwait Public Policy Center's flagship lecture series program. I'm your host, Mubarak Al-Sabah, and tonight we've got two very special guests from the International Monetary Fund to discuss breaking the oil spell, economic diversification and industrial policy. Allow me to introduce our guest speakers, Mr. Reda Cherif and Mr. Fuad Hasanov, senior economists at the IMF. In addition to being a senior economist at the IMF, Mr. Cherif is also an affiliated researcher at the Bennett Institute for Public Policy at the University of Cambridge. He joined the IMF in 2008, and his research covers development economics, natural resources, industrial policy, and growth and innovation. His book, co-edited with Mr. Hasanov and Minzu, Breaking the Oil Spell, explores economic diversification in oil exporters. Mr. Reda holds a PhD in economics from the University of Chicago. Mr. Fuad Hasanov, senior economist at the IMF, is also an adjunct professor of economics at Georgetown University and an affiliated researcher at the Bennett Institute for Public Policy at the University of Cambridge. Before joining the IMF in 2007, Mr. Fuad was an assistant professor of economics at Oakland University in Rochester, Michigan. His recent research focuses on natural resources, growth and innovation, and industrial policy. He is the co-editor with Reda Cherif and Minzu of Breaking the Oil Spell that examines economic diversification in oil exporting countries. Mr. Fuad also received a PhD in economics from the University of Texas at Austin. Mr. Cherif and Mr. Hasanov will tonight be speaking about how diversifying the economy from oil dependence while maintaining a high level of income requires more than standard growth policy prescriptions, which includes an enabling business environment, macroeconomic stability, and minimum state intervention and regulations. They argue that the leading hand of the state is necessary to fix market failures and develop new industries and markets. In particular, the state should create and support export-oriented sophisticated industries while imposing a strict accountability framework based on market signals. The key to success is the creation of technologies and innovation by domestic firms and a push to leapfrog to the technological frontier at an early age of development. Policies to do so could still, quote-unquote, make a miracle in many countries today, as they did in Singapore and other East Asian economies in the past. And without further ado, we pass the mic to the speakers. The floor is yours, gentlemen.
Thank you very much, Mubarak, for the invitation to present here, albeit virtually, but it's still very nice to be here, and for the very kind introduction. So I'll start kind of the talk, and I kind of leave the hardest part of the presentation to Reda, so it makes my life a bit easier. So it's a pleasure to be here again. I know actually both of us worked a lot on the GCC states. Actually, I worked on Kuwait many years ago, so we traveled to the region quite often. So hopefully once the pandemic is over, we can all meet in person as well. So let me share my screen, my slides, and I'll just jump straight into the discussion. So here we go. All right. All right. So, of course, I gotta give a disclaimer that, these are our views rather than the views of the IMF, based on kind of our work we've been doing with Reda and others over the past several years. So let me just start with the following quote by late founder of Singapore, Lee Kuan Yew, who essentially said, if we want Singapore to be around, in 100 years from now, we have to essentially have the right government so that we plan and do what is needed to keep the momentum going. And he said, otherwise we'll essentially sink into nothingness. He didn't talk about markets or business, or he really talked about having the right government. And this actually is kind of the thrust of our talk, because we look at, for example, this chart here about growth, and it's kind of the question that has puzzled economists for many years, decades, centuries. What is kind of the grail of development and growth, right? And you look at this chart for the past 60 years, real GDP per capita in purchasing power parity terms. So this data come from the latest Penn World Tables 10.0 that has just come out, I think, recently. So you look at a country like Korea, which was the poorest of all this sample of countries that I have here in Asia, Latin America, Africa. It was the poorest of them all in the 60s and even 70s. And now it's actually in the club of advanced and rich countries. Right? You look at this chart and you see how it just went essentially within a few years, within a few decades, from low-income country to high-income country. While many African countries stagnated, you can see it here. Just an example of Ghana, but it's the same in many other sub-Saharan African countries. You look at many Latin American countries who some of them did relatively okay, ended up in middle income, which is essentially what we see also in many other Asian countries like Malaysia and Thailand and others, right? But they haven't achieved the same growth that Koreans have managed to achieve. So the question is why? And just, since the audience is from the GCC, just we put together, the same Penn World tables, looking at the relative income. So it's GDP per capita relative to the US GDP per capita over time. And you can see that many GCC countries, which were relatively rich, as the oil prices were high and there was a lot of oil, discoveries in the 50s, 60s, 70s, it was multiple of US GDP per capita. And over time, this relative income has essentially shrunk. So many GCC countries now are either at par with the US per capita income. So, Qatar is slightly higher. I think Emirates is slightly higher. Kuwait is about the same. And Bahrain, Saudi Arabia, and Oman are slightly below. So, this pattern actually you see in many oil exporting countries. As you have a boom in oil prices or discovery of oil reserves, you have a huge increase in income per capita, but over time there's just stagnation and kind of decline. Right? So the issue of diversification becomes actually very relevant, not just for the GCC countries, but also for many other commodity producers. And actually going forward, it's not just the kind of boom and bust of oil prices or oil discoveries. Now we're really at the cusp of the energy transition. And this is a chart from the paper we've done years ago. And of course, no one believed us then, but now I think it's just a matter of time rather than whether it will happen or not. Essentially, what we've done is we looked at how cars were replaced, how horses were replaced by cars in the early 20th century. And we kind of used this analogy and projected how electric vehicles will replace motor vehicles kind of in this century. And what you see is, you see that electric vehicles are actually growing, if not faster than motor vehicles were growing in the early 20th century. So these are the blue lines you see here on the chart. And then the orange line is this, how fast the horses were disappearing. So essentially within 30 years, a lot of horses that were actually used as transportation vehicles, they essentially disappeared and then essentially went to zero. Right? So the horizon is relatively low. And we say that in the paper, we argue that, essentially by 2030s, it will become widespread. And then by 2040s, essentially as oil is kind of the main kind of fuel for transportation, and now it's going to be competing with other fuels for other types of energy mix. The price is going to drop substantially, and it might be similar to the price of coal and price of gas, which is essentially about $15 per barrel in equivalent terms. Right? So once the prices fall, the issue is it's not, even if you use oil, it's just not enough to sustain high living standards with low prices. Now, if we go back to this chart of, how do we think about growth overall, as I've mentioned, Korea has done really well, but it wasn't just Korea, it was these 4 Asian miracles, Hong Kong, Taiwan province of China, and Singapore. And here what we've done was we looked at kind of the GDP per capita relative to the US in the 70s on the x-axis and GDP per capita relative to the US in 2019 on the y-axis. So the 20% line is essentially kind of high middle income threshold. 50% of US GDP per capita is the threshold for high income. And you can see that only a few countries made it to above 50% line. Now you see Korea, Taiwan, province of China, Hong Kong. Singapore is essentially of the charts, its GDP per capita is higher than the US, so it's above 1. And then you have a few European countries who made it as they were in proximity to kind of the engines of the European Union, like Germany and France and others. And so you see Poland and few other smaller European countries here. And then few islands, like these Virgin British Islands here, and I think there are a few others like Aruba and Malta. So if we kind of think about growth, it's really in these Asian miracles who have essentially went from low middle income countries to high income countries within essentially a few decades. And the question is, can we learn anything from them? And this quote from the Nobel laureate in physics actually says, we don't want to think kind of in average terms, right? I mean, if you run regressions, essentially that's what you do. You look at averages, right? But we want to look at these outliers, like the Asian miracles, because they have a lot of information. And if you kind of think about these more complicated distributions, like power law distributions, then essentially a lot of information is in the tails. And what we learn from the Asian miracles is what we call true industrial policy. And once you kind of dig deeper into what this true industrial policy is, essentially it amounts to what we say also a technology and innovation policy, or a TIP. And it's essentially a TIP for growth. So the 3 key principles of the analysis is, or 3 kind of main points of what needs to be done, is essentially going into sophisticated industries, kind of creating capabilities and moving factors of production into these technologically sophisticated industries, going beyond current capabilities, going beyond existing competitive advantage, right? And that's really important. That's what the Asian miracles have done. And that's actually what is China essentially doing today, and what Japan has done before the Asian miracles, and actually what many other advanced countries were doing in the 19th century. Advanced countries today which weren't advanced in the 19th century yet. The second point is about exports. It's really important to kind of focus on exports, and there are many reasons for it. Kind of market signals, kind of economies of scale, huge markets, the world market, competition, and so on. So it's really about exports. And the third point is about competition, right? It's of course exports will give you the competition abroad, but it's also the competition at home. So especially when there is a support from the government to provide firms and grow and so on, you cannot know which firm will succeed. So you want to make sure that there is enough competition in the industry. And of course, the accountability for the support received. So this interaction is really what is important. And we believe that's what kind of drove the Asian miracles to grow really fast for many, many decades. Now, if we think about, so to succeed at high growth, sustained growth for long periods of time, rather than kind of for short periods of time, it's all really about dynamic export sectors. So the question is, what are some of the elements of thinking about creating those dynamic export sectors. So as I mentioned earlier, it's about export orientation rather than import substitution or non-tradables like real estate or construction, right? And there are many reasons. Of course, one reason is competition. Another reason is competing with the best, so continuous improvement, kind of going up the quality ladder, provision of market signals, knowing which firms will make it, which firms don't make it. And of course, there are also political economy issues related to that. And these issues are essentially related to kind of cronyism or capture or many other political economy problems that once you start exporting and competing on the international markets, you have no choice but to do your best. And this is different from kind of these import substitution policies or what was known as ISI in the 60s, 70s, when many countries tried this, closed the markets, closed the trade, and essentially were either captured or didn't improve much, didn't innovate, and of course didn't grow. They were relatively small and inefficient companies. And of course, once there were different shocks hitting the economy, they couldn't just sustain their operations, and they all folded. Right. So this is the important issue, and many countries I think are understanding it, but I think it's still not a complete way of kind of convincing them that they need to focus on exports. I think there is still some kind of idea of trying to do import substitution. The second part is about domestic capabilities rather than some sort of portfolio diversification. And good example is Norway in the 70s when it discovered oil earlier on, it started developing its own capabilities in oil service industries, in manufacturing of production of submarines, platforms, drilling equipment, and so on, rather than just maybe going downstream and only doing kind of forward linkages of petrochems, metals, and so on, which many other oil exporters have done. Right? So also developing a lot of backward linkages, building capabilities, and then exporting it to the rest of the world. Right? And also going beyond just collecting oil revenues and putting them in sovereign wealth funds. So Norway has done both. They have both sovereign wealth fund and also they've created their strong domestic companies building various complicated products. So that's also very important. So it's not just focusing on portfolio diversification. The third component is about sophistication. So sophistication has a lot of, why we argue we need to go in sophisticated industries, because there are a lot of linkages with other goods, spillovers, intermediate goods that go into complicated goods. You know, if you think of cars, how many parts you need to produce a car, airplanes, computers, you know, you name it, electronics and so on. So there are a lot of connections with other industries. And it's different from just going into agriculture or just improving on food processing or even services, even high-tech services like maybe finance, which might require high-skilled workers, but doesn't require many workers. So it's the issue of employment as well. Tourism may actually employ many people, but it's very low-skilled. So you don't really end up kind of in these productivity gains that are required for long-term growth. So you end up doing the same thing and the growth stalls after a while. Unless you can, bring more and more tourists and do more kind of fancy stuff, but there is a limit to that. And the last point I want to make is about kind of competitive advantage of working within competitive advantage and beyond. And that's what many economists say. You kind of, this is your competitive advantage. You should stick with it. But, you look at the Asian medicals, they started doing stuff that they've never tried before, like cars, ships, electronics, and so on. So it's the issue of how you build your, what you want to say, competitive advantage, right? And Koreans and even Malaysians have managed to do it. Malaysia kind of stalled because they only focused on FDI. They brought foreign companies, but then they couldn't go beyond it. Koreans managed to build their own companies and go much beyond what Malaysians and others have done. And then you can look at Chile, which actually, even with the state support, did a lot of industry development, but mostly in competitive advantage industries like agriculture and salmon and blueberries and so on. So it gave them some boost but it didn't catapult them into high income status like it did for Koreans. So the question is then, what is this sophisticated industry? And if you look at R&D intensity, so R&D spending as percent of GDP or sales, depending how you look at it, which data you use. So here is OECD numbers, and you look at all these different industries with highest R&D spending. Essentially, these are electronics, pharma, transportation, different equipment, machinery, chemicals. And then you see a few services here as well, like IT, science, related services, and so on. But it's mostly manufacturing industries, and you can see mostly manufacturing, and it's not mining as much. You see mining and other types of services are down the line. There is not much R&D happening there. So if you think about sophistication, that's kind of what the sophisticated industries would look like. And these were actually the exports and the industries that the Asian medicals went into. So the question then is, if these are the sophisticated industries, we want to go into these industries, we want to create these dynamic export sectors, what do we do? And in this book, Mubarak kindly mentioned in the beginning, we did a conference in Kuwait in 2014 when oil prices were still high. We had to convince people that oil prices could fall. They did fall 6 months after. And diversification, wasn't still kind of on the minds of many policymakers. But now I think it's pretty clear that even if oil prices are rising in the short run, in the long run, there is a problem. And we argue in the book that it's not just fixing the kind of government failures or kind of the business environment and regulations and supporting human capital, education, or infrastructure, and so on. You have to go much more beyond that, and that's essentially market failures that essentially are, many of these industries are laden with. So we need the state intervention, or what we call the leading hand of the state, to intervene and fix many of these failures, coordination failures, learning failures, and economists know well about this. Goes back to Krugman 87 paper of learning by doing, and many other types of failures, information failures. No, the firms just won't go into sophisticated industries. Just when many failures, it's too risky, and firms would prefer to stick to non-tradables or other industries where profits are pretty clear. And in the GCC countries, it's a very nice quasi-natural experiment because a lot of things have been done, improving infrastructure, education, and many other things. But we don't see a lot of productivity gains. As we saw, relative income over time is declining. So one example I want to give before I turn the floor to Reda is the importance of exporting. It's kind of this pursuit of global markets. Great example is based on the paper we did on Malaysia a few years ago, is Malaysia's Proton car, which also tried to start the auto industry about the same time as Korea. And they started in the 60s, late 60s, early 70s, and in the 80s they were already kind of full steam ahead producing, but they kind of took different roads. And Malaysia was very inward looking. So it kind of pursued this import substitution policy, closed the market, didn't innovate much. There was a lot of mismanagement and, of course, political economy problems. At some point, it managed to do well. It even bought the UK's Lotus and improved the production to almost 500,000 cars, but it was only short-lived. Koreans actually, from the onset, they were thinking of exporting to the US. Took them a while, they went to other countries, Canada, and eventually they came to the US. And they essentially thought of, we're going to move first, learn, and adjust. So that was their approach, the learning by doing type of approach. They had a lot of failures along the way, but they were very persistent and continuously doing it with the state support. And of course, the state support came with the strings attached, and these strings were essentially the export market shares. They had to show that they were growing in their export market. And moreover, they were producing their own kind of parts, especially the engine. They produced their own engine, unlike Proton, which used Mitsubishi engine till the end. And I think recently Proton was sold to Chinese Geely. So The important part here is that they were doing on innovation. They were looking at the global markets. They were trying to export. They were persistent, and they were actually competing not just outside of Korea, but even inside. You know, it wasn't just Hyundai. It was actually Samsung. There were many others, you know, big firms, Chaebol, who were competing amongst each other to succeed. And of course, not everyone succeeded, but that's the whole point. The industry succeeded, not necessarily each firm. And that's really important. It's about the industry rather than firm. So let me pass the floor to Reda, and he will continue with the presentation.
All right. Thank you very much. Thank you, Mubarak, for this kind introduction. And I hope you can see the slides. Yeah. It's a pleasure to talk to you today. And as Fuad said, we've been many times to Kuwait, including me when I was teaching, traveling from DC to Kuwait to teach at the CEF. So yeah, great memories and great to have you all here. So let me jump in right away. So Fuad basically laid down kind of the principles of this technology and innovation policy. And one of the key elements was entering into sophisticated industries, right? And export oriented. So what I'll do now for the second half of the presentation, I'll show you more evidence about why technology and innovation is important, when it should be done and how it should be done. First of all, so this graph is pretty much a comparison between Korea, Chile, Malaysia, and Taiwan province of China. And it shows there basically how they moved in terms of innovation. What you see here is the number of US patents granted in the, right? Basically, it's patents granted to companies from these economies in the United States. The horizontal red bar is the year when Korea took over Malaysia in terms of GDP per capita, just for reference. So this is kind of a good comparison because Chile and Malaysia are countries that did pretty well in terms of growth relatively, but also they were doing better than Korea and the Taiwanese in the mid-80s along several dimensions, right? So what you see here is that somehow in the 80s, so much earlier than what one could expect, right? Or basically intuitively could have imagined, the number of patents started taking off, right? In the Asian miracles, much earlier, and the divergence is just huge. So you see already in the early 80s, and then it continues and it keeps diverging. In other words, Korean and Taiwanese firms were much more active, much more innovative, and much earlier. And our conjecture is that this difference in terms of innovation, right, and technology led to this big divergence in terms of growth between these economies. And that's important, it has huge implications. Let me give you another kind of piece of evidence about the extent to which the Koreans were innovating much earlier than what I would say the data would have predicted. So this is a graph where you see again the patents. This is the logarithm of patents per million people, just normalized. So the red curve, if you want, is the number of patents given to Korean firms in the US. And then what you see here is that whenever you see a blue label, that's a country, this is the year where Korea reached the level of GDP per capita of that country. And then, of course, it kept growing much faster. So you see in the early 70s, you see Philippines, Tunisia, they had more or less same number of patents. And then somehow in the 80s, right, when Korea reached the level of Brazil, they have more patents. Chile, just before the mid-80s, much more. Malaysia, much more. Mexico, Portugal, Greece, Slovenia. So it continues. In other words, the Koreans have always done a lot more innovation, right, than what their GDP per capita would have predicted. And then if you fast forward at the end, these are the labels kind of a bit darker. You see that even in 2015, Korea has one of the highest levels kind of innovation measured or proxied by the number of patents. So in other words, there was a lot of innovation happening in Korea and technology creation, and it happened extremely early on. The implication of this are pretty big because it tells you that countries in general, and specifically countries hitting what people call the middle income trap, right? There's really kind of a strategic choice here. So those who would focus on, as Fuad mentioned, right, low technology sectors, right, such as tourism, finance, I would say logistics. Well, we're not saying these sectors are not, conducive to create wealth or they cannot be, I'd say, profitable. But on a national level, and if you look at these cross-country comparisons, there's evidence that you cannot rely on these countries first to move from middle income to high income, and then by extension, most likely, if you're a high income and you only rely on those sectors, and if, let's say, you're wealthy because of oil and oil price falls, it's very unlikely that you would keep your high level of income, right, just relying on those sectors. The counterpart of this, if you look at the Koreans' experience, well, the only way to keep high income or move from middle to high income is actually to focus on high-tech sector. Now the question is, who should do this investment in high technology and who should enter? So in this figure, what we did, we looked at data on R&D in the OECD countries, right? So it's kind of this spider curve. The blue area is the OECD median, and then we compare to kind of the red spider, if you want. This is for Korea, and then the dash one is for Finland. So that gives you a breakdown of R&D. In other words, it tells you what's a sketch who typically does most of the R&D in the most innovative countries, right? So that's why we picked Korea and Finland, and then we compare to the median OECD. So the first very important element, before even I go into this, is that for the most innovative countries, the biggest chunk of R&D is done by private companies, right? It's not public R&D. So public R&D is big, but it's just a third, right? So 2/3 of it is done by private firms. So in other words, if you want to be in an innovative country, well, private firms have to do most of the R&D. And as Fuad showed before, the sectors where R&D intensity is high are known, right? They're pretty much IT, high-tech manufacturing, and so on and so forth, and they are not tourism, agriculture, and mining. So that just already gives you kind of a hint at the, where things should go. The second element is this graph is showing you what's the breakdown of the R&D among these private firms, right? And what you see is that, so let me summarize. What happened is that in the most innovative economies, most of the R&D is done in industry that we could have guessed. It's done in high-tech manufacturing. Again, we could have guessed that. But then more surprising, perhaps, is done mostly by large firms, right? That has big implication because these are not SMEs, they are large firms. So in other words, if you have policies focusing just on SMEs, especially without pushing or kind of having policies that would help them grow, you will not have the same level of R&D. These R&D is done mostly by domestic firms and not foreign affiliates. Again, that also has implication of policy. So policies that are completely focused on R&D, on FDI to increase R&D may not be as successful. And then finally, you could see these are not services, right? This is mostly manufacturing. Again, so that tells you if you have policies that ignore or actually focus completely on services, most likely the outcome would be a low R&D intensity. So that gives you an idea, right? So you need large firms, or at least small firms that grow into large. They need to be in industry, and then you need this domestic kind of element, right? They need to be domestic firms. So in terms of the policies to achieve this, I'll give few example or country cases and extract from each one of them, I would say, lessons in terms of policy. So the first one is kind of the story of the Taiwan province of China and how they entered into electronics. What's important to know is that when the Taiwanese entered the electronic, first they decided, it was a strategic decision at the highest level of their authorities. Right? So they said, we want to enter electronics it will be, decided at the highest level, and will pursue it. When did they do it? They did it in the 70s, early 70s. And that's a time where they had the GDP per capita of Tunisia today. So it just tells you, right? It's as if Tunisia today decides to go into the frontier technologies. Now, the important element is how did they do it? So what's interesting is that first, the way they did it was not, did not require a lot of capital. In today's dollars, it would be something around perhaps $1 billion or $1 billion or two. So it's a relatively small amount. These are not the huge investments of the Korean chaebols, no, these are conglomerates. And also the way they did it is they started with, I mean, we say SMEs, but really they were startups, no? So they created this farm, right, or spin-off system to create these startups, and these startups grew very fast. So this system consisted in kind of different layers. In the institutional institutional apparatus they used is they had an institute called ITRI, Industrial Technology Research Institute, that was an umbrella kind of institution that piloted the whole effort. They took care of every aspect of the success of the electronic sector. They set up a public research institute. They sent thousands of students very early on to study electronics and engineering, all in Silicon Valley. They made sure to have links with multinationals. And more interesting is that they licensed themselves technologies from the US. They sent people to study this technology, train on them, and they brought them back. So they were pretty much civil servants. And then after a few years, when they started kind of learning these technologies overnight, these people were spun off. So they turned from civil servants to a startup, a private company. They helped them, they gave them seed money, they even let them work within the public labs to give them time to grow. And interestingly is that the first company they spun off was UMC. Today is the second largest microchip producer in the world, and the second one is TSMC, which is the largest in the world. I think it's 60 or 70% of world production, with revenues in the tens of billions of dollars. So huge success, relatively small investment in the beginning. What's interesting is that the public sector had to intervene to, of course, do all this technology creation, help them get the licenses, but also give them finance. No, the private sector was very reluctant to enter, which again emphasizes the point made by Fuad earlier that the perception of risk by the private sector might not be correct, right? Because if you followed kind of their their hunch at that time, the Taiwanese would have never done electronics in the 70s, and they wouldn't be as rich. So extremely high successful program and with relatively small, initial investment. Interestingly also is that they reached the technological frontier extremely fast. It took them basically a decade. Of course, hard work, some investment, but they succeeded very fast. So it tells you it's possible, even in the high-tech industries. The second example is Nokia in Finland. So what's interesting about Nokia is that this time it's not a startup that was created, but it was already an existing firm, but it was not an electronic firm. It was basically working in paper mill, basically producing rubber boots. And this company turned, somehow by serendipity, but also very important, thanks to the role of the state and its intervention, they became a major player, right, in the mobile phone industry. Now, the policy tool that was used this time is procurement. So the government procured kind of a new system, right, of wireless phone, because it's very cold, right, in the north. And thanks to this procurement, they asked companies to compete and innovate. And of course, that kind of helped Nokia emerge. So that tells you that public procurement to solve specific problems, right? So in that case, there was remoteness, cold, and so on. You could draw parallels, I guess, perhaps with some Gulf countries, the heat and other elements. To solve your own problems, you can use your procurement to actually push for innovation and then create these successful firms. There are other parallels with the Taiwanese is that they also had these umbrella institutions that piloted the whole effort, right? So there was ITRI in Taiwan province of China, and you had TECAS in Finland. There was also parallel in terms of public research institute, right? The Taiwanese had ERSO, the Finns had VTT, which helped a lot, actually Nokia in its innovation. They also had both a high-level scientific council that helped them actually take these decisions and kind of, go into the right sectors, right? So we have STPC in Finland and STAG, the Taiwanese had STAG, which is interestingly, STAG had no non-Chinese, I'd say, all the participants in the STAG in this council were non-Chinese. They were renowned experts, and they gave them ideas about how to enter into the most innovative sectors and innovate right away. Interestingly, also, big chunk of R&D of Nokia in the 80s and 90s was funded by TechUs, right? So that tells you the government was still there to help them, right? And then also from the late 90s, 2000, Nokia became the biggest player in terms of R&D in the country. So one company representing a third of total R&D. So in this example, you see that you have one company that became huge and became a big engine of their innovation. Now, another case we looked at is the university-centered innovation, and that's the case of EPFL in Switzerland. Now, why is this important? Because if you you want to invest in technology and innovation, you want to create these dynamic sectors, you have really to rely on universities. Because first, it's not just creating the skills and education, but there is also, I'd say, room for university to directly collaborate with the private sector. And the Swiss example is the best. So they have large investment in basic and applied research in universities, but they also have pretty big, I'd say, institutions like the Swiss National Foundation and the Commission for Technology and Innovation that gives directly grants for projects that are in partnership between private firms, including large firms, and labs, right? University labs. And this is pretty successful program, right? That leads to innovation, leads to these links between their engineering school and the universities. Another aspect of the success of Switzerland, and why, by the way, why we look at Switzerland, because it's if you look at different dimensions, it's the most innovative country in Europe, right? And then we're trying to explain, right, what's the secret, if you want, of this success. Another element of their success is this policy to attract foreign talent. So compared to other European countries, is the country that has the highest rate of foreign students among PhD and master students. If I recall, it was something like 67%. So really this openness to attract the best help them innovate a lot. And then finally, that's very important. So if you want universities to be active in terms of, creating firms, in terms of creating technologies and collaborate with firms, you need the proper legal framework. So what kind of in the paper we're working on with Fuad is that we noticed that in the 90s, there was a reform of the framework of these engineering school, especially EPFL and ETH in Zurich. EPFL is in Lausanne. And then since then, it helped them because they were able to produce their own patents. They were able to create startups, or I'd say involved in the creation of startups. And they did through various funding instruments. They had their own innovation parks. In other words, you can really create an ecosystem around your universities, right, to create innovation. And then this is the kind of final example, which is Singapore's foray into biopharma. Again, this was a strategic choice at the highest level. In the early 2000s, Singaporeans detected, or if you want, identified biopharmaceuticals as one of the leading sectors of the future. They put together a ministerial committee for life science, again, very high level, but also, an institution that would drive the effort. Now, I keep insisting on driving the effort because for every sector has its own requirements, right? And there are many of them. And this example shows it, I think, in a very stark way, that if you don't have a focus, then the sector cannot succeed because you need an institution that would coordinate all the other agencies to make sure that all the requirements are here. And in the case of biopharma, what we saw is that this committee, right, made sure that first they put together research institutes, right? So you need to do your own research, you need to put the skills, invest in the skills. They helped in partnership with industry, including with multinational. they send hundreds of students to study in PhDs abroad, right? Technicians and so on. So they put together the human capital. Like if you just rely on the usual, Ministry of Education, well, they have many things. They don't have a focus here. They coordinated with Ministry of Education to have a focus on biotech, and they sent people to do it in specific skills. They created, excuse me, excuse me. So they created a specific infrastructure, right? So an infrastructure dedicated to biotechnology will be very different than one dedicated to other sectors, right? So you need type of labs, you need the type of infrastructure when you can run these experiments, and they did that. They created Biopolis, which is a physical hub for medical research. Even the way they build it next to a hospital because you need to do the clinical trials, right? And you need the link with the hospital. They created specific funding instrument to help these firms in biotech. And then finally, even the legal framework they changed because to run clinical trials and stem cells, they had to change the laws. In other words, there is, it is clear that first you need to focus. Why? Because once you focus, you know all the requirements you need. And then if you have the right institution, it will coordinate among all the agencies and make sure that you have all the elements of success, right? On top of what we discussed before, at least what Fuad told you about kind of the principles of this technology innovation policy. So broadly speaking, let me just give you a summary of the kind of policies needed. First, you have to think in terms of this firm duality, firms and workers. You have to change the incentive for firms. How do you do it? You need purpose-specific investments. And for example, in skills and infrastructure, as we showed it in the example of Singapore, you need this university-centered innovation and you need to create industry clusters. Agglomeration is very important. So it's not about helping one firm, it's really about creating an industry. Many firms may, may go bankrupt in the process, but the industry itself may succeed. You need funding and business support and all types of support, especially export promotion agencies, because for small firms don't have access to foreign markets. This is important. Development banks can play a role in terms of especially early financing. Then you have to think about incentive for workers. I guess this is very important in the context of Gulf countries where you have high proportion of workers who work in the public sector. We touched upon some of these in the staff discussion note with Tim Callan. So Fuad and I are workers. And we gave some proposition, but there's definitely room for kind of new ideas and how to give incentive for people to go into the private sector, specifically to invest in the right human capital. How you do that? Improve education quality. That's, I guess a lot of people are looking at that, but I guess early childhood could be really important for because it has long run effects in terms of, not just how people perform, but also how, their work ethic and so on and so forth. So there's a lot of research on that by Jim Heckman. Teacher quality, vocational training, and study abroad are all important. And then social attitude. So in the book we co-edited with Fuad and Minzu, we looked at the experience of the Koreans in the 60s and 70s with social development programs. These are programs meant to change social attitudes. And I guess the idea is not to have the same program. Some of it was pretty harsh actually, but you could get inspiration to think about programs to encourage entrepreneurship and risk-taking, right, in today's environment. Finally, so let me conclude. So the idea is not about picking winners, but creating them. So the key is exporting activities. We cannot insist enough on that. It has to be done by domestic firms. And by the way, saying that domestic firms are important doesn't mean that they should not have partnerships or you should not have FDI. This just to say that there should be policies specifically designed to help these domestic firms, right? Create homegrown technology. But it's always done, there are always partnerships with MNCs and other firms abroad. It's about picking sectors and missions rather than specific firms, right? As I said, and we showed you with the example of Singapore, Finland, and so on, because each sector has its own specific requirement. You need to be very precise in that sense, not like the subsector, but the large sector, because that will help you identify all these requirements and coordinate among all your agencies. To succeed at creating homegrown technology, you need competition in the international market and domestic market. You have to push firms to move to the frontier technology frontier early on, and you have to enforce market discipline and accountability. Of course, if these are blank checks, there's no incentive, to innovate and compete. And then finally, investment has to be purpose specific, right? Whether it's skill, infrastructure, right? And you have to think about aligning incentives for firms and workers to precisely go into these sophisticated sectors and compete on international markets. Thank you very much.
Thank you very much, gentlemen, for a very fascinating and thought-provoking lecture. We will now open the floor for a quick Q&A session, if you guys don't mind. There are a few questions that were raised in the Teams chat. First question by Mr. Mohanad Sabahi. While exports is important, import substitution was the main driver of growth in most developed countries, in brackets US, Germany, isn't it?
Let me take a stab at it. It's a good question. Actually, if you look at the 19th century, the environment was somewhat different than today, for sure, of course. US, Germany was relatively big countries, especially the US at the time. So they did, of course, have, they had trade protection. That was kind of the instrument of the day in those days to make sure to develop their own industry. So you can think of it as infant industry protection, because Britain was the main manufacturing powerhouse of the world then. So they were trying to develop their own manufacturing, and they would use huge tariffs to develop their own industries. And then, of course, they had huge public investment projects like railroads and so on, right? That kind of drove growth, kind of in a way, what to some extent that China was also doing with infrastructure development, or has been doing for the past several decades. So there was this element of, I guess, import substitution in those days. They would essentially make their big firms and kind of other firms to build, develop, and eventually, of course, when they would become relatively big, then they'll compete with the rest of the world. Now, the question today is it really required, right? And is it the right environment? Can you really do that? And, especially if you think about kind of trade protection. And what we argue is that you don't really need it because it's just one instrument, right? It was used in the past. That was the main instrument of the past. Actually, Koreans and others also used it a lot. But, in today's environment, it's going to be very hard to use. And is it really the most useful one or helpful one today? And there are many other instruments that you can use while being open to trade. And you need this, openness to trade, because for many economies, which are small economies, need the world market to grow big industries. Otherwise, it just won't work. And I think one element to that story is that, there's always a chance you can succeed while protecting your industry from outside competition. But the question is what the probability is that you will succeed, right? You can always succeed. It's not zero probability, but it's probably much smaller probability of success unless, you open it up to the rest of the world and compete on the world market. But it's true, you need some sort of kind of infant industry protection, but it may not necessarily be trade instruments, right? And in that sense, exports are still important, especially today. And they were actually also important in the past. It's just big countries managed to pull it off with kind of, big markets and kind of ISI type of approach.
Well, I'll just add just a few. I think Fuad summarized it. It's a very important question. Thanks, Mohanad. Just to add to Fuad, it's pretty much the same element, but I'll perhaps say them a bit, kind of give a new light. First, the distance to the technological frontier was quite different in the 19th century, right? Between US, Germany, and let's say it was Great Britain and France at that time. So that was one explanation, if you want. So if you close, maybe you had more chance to kind of reverse engineer what they were doing if it was steam engine, right? But today, laptops, computers, and so on. It's much more difficult to do that without access to international market because, well, you have to import some inputs, you have to export. So now the value chains are much more, dispersed. Like another element Fuad already mentioned, right? Your small economy, right? You cannot succeed if you don't reach a minimum scale, right? Because of this increasing return to scale. So if your market is small, then you're already doomed, right? You may enter, like, I don't know if a very small country can even enter auto industry, right? It's so big, investment so large to start becoming profitable. So that's the second element. And now even with these, right? There's an example we studied with Fuad in our 2019 paper, The Return of the Policy That Shall Not Be Named. And we look at the case of India, which is a very large economy. They had the human capital, they did all the requirements, and yet their import substitution policy, especially in automotive, did not succeed, right? One of the issues is governance, competition. So once you close your market, you open room for, a lot of cronyism, distortions and so on. So you need also to do this export orientation because it gives you a clear market signal. I think Fuad mentioned it. So export is a market signal that you cannot kind of falsify, and that helps you in terms of accountability.
Thank you. And moving forward, Mr. Mu'izz Al-Aradi has asked, given a more globalized economy today, with existing sophisticated and competitive manufacturing channels in place, for example, China, are the earlier experiences mentioned, in brackets 1970s Korea, generalizable to 2020s GCC countries?
It's a great question, I guess, $1,000,000 question. How do you apply the lessons learned from the past when it wasn't exactly the same as today to say, GCC countries and many other countries that try to diversify and innovate? I would say, that's why, when we look at this and kind of hopefully in the presentation, we managed to bring it across, kind of the key principles of what could be done. It's true, the environment is somewhat different, but I think the key principles are still there. So if there is a focus on kind of very high level of going into sophisticated industries, whether it's pharma, whether it's electronics, or whether it's some IT services or anything of the kind, there is this kind of ambition and kind of persistence to do this. That's kind of the first element. And then kind of what Reda has mentioned, thinking about this purpose-specific investment. If I want to go into pharma or I want to go into electronics, what do I need? What do I miss? How do I develop it? And you can actually do it relatively fast. I think Ireland did it in the 70s when they brought in all the US multinationals in the electronics industry and also pharma. They didn't have any electrical engineers. So they took their physics, math majors, created a program. Within 2-3 years, they were churning out electrical engineers. So you can be relatively innovative in how you approach it, and you don't have to kind of redo the whole system, education system, or you pave the whole country and electrify the whole country, right? You can be very focused. You can be very focused to achieve it. So that's another element that is still applicable. So you really focus and you apply the relevant investment, right, to do that. And then, it's, as we've mentioned, it's like the links with the universities, certain instruments. They don't have to be trade protectionist instruments. They could be some sort of support to young firms to become big, export promotion agencies, financing, and so on, to help these firms grow and export. Right, and at the same time innovate, which means you need R&D spending. You need to give them support for R&D, whether it's public or whether it's private, and that over time gives you this kind of dynamism to be able to succeed. So I think this is still applicable, and unfortunately many countries do some parts of it, but they don't have this kind of whole strategy to implement it. Right, there is a lot of discussion. Some parts of the strategies they're trying to do, and there's also no persistence. So this thing is very piecemeal. I'm sure Reda has more to add.
Thanks. Just because part of the question was in the context of China, right? So I guess just to add to Fuad, I guess the question is also, can the GCC countries compete with China, right? That's my understanding. And exactly what Fuad said actually applies too, no? You need a sense of focus. Why? We already have examples of countries who are, in a sense, competing successful with China. You have Denmark, Germany. These countries have, you know, current account surpluses actually vis-a-vis China. And how they do it, they're not doing it by doing it for substitution or, you know, trying to compete in toys or shoes, no? They're doing it by having their own niches, no? Highly sophisticated niches, though. And for example, Denmark does a lot of kind of high-tech services around the renewables. They also do manufacturing. So in other words, exactly what Fuad mentioned, you need a sense of focus. And that actually contradicts the path of import substitution, right? So you cannot compete, you know, with these huge countries on like cheap labor. But if you focused on the right sophisticated sector, actually it could be a pretty successful kind of strategy.
Unless there are any additions, this should be the last question. His Excellency Dr. Khalid Al-Mahdi has asked, today the Brent oil price hits $80. Will the oil spell continue? I'd like to hear your outlook.
Thank you for this great question. I mean, if we were kind of oracles looking into a crystal glass, yeah, I guess we would know more. But I mean, we know that the oil markets are pretty volatile. So the $80 price today, you know, given kind of many economies are getting out of the pandemic, some shortages in the supply, and kind of relatively high demand. So it's not surprising oil prices rise, and they may actually stay high for some time. But at the same time, given what we mentioned earlier, it's actually gonna accelerate the energy transition. So it even creates more incentives for people to start switching to electric vehicles and investing in renewables and so on. So actually having high oil price for relatively long periods of time, it's just going to accelerate the whole thing. So it might be high for some time until supply kind of catches up, goes back to, you know, kind of maybe some equilibrium level as we've seen before the pandemic. But then the question is, you know, renewables and electric vehicles are getting cheaper and cheaper. And it's just a matter of time. I think our projection is by 2030s, you know, it's pretty much the game will be over. And then the prices will start dropping relatively fast. So it doesn't give much time to many oil exporters to diversify. I mean, 1 decade is not really a long time. So it's really the argument for diversifying right now, and there is not much time to waste.
Yeah, I think perhaps just to illustrate exactly the point about how let's say, difficult to know where price will go, oil price will go. But let's say if it goes up, what would happen? 10 years ago, kind of the most viable electric car would have costed, like, let's say $80,000, $90,000. Today, you can buy a very good electric car for $35,000. So if the oil price shoots up, let's say beyond 100, I think people will start making, you know, newer arbitrage that they couldn't do 10 years ago. And exactly the point that, see, exactly. So high price of Brent can actually accelerate the transition, and everything is ready for this, renewables, electric cars, and so on.
Thank you very much, gentlemen. As mentioned, it was a very fascinating and thought-provoking lecture. You contributed with your great insights on such an important and relevant topic. Breaking the oil spell is an important work that contributes a lot towards our understanding of how a future pivot to a post-oil world might be feasible. So that is extremely topical, extremely relevant, and I'd like to thank you all greatly for your insights. Thank you again. Just one last announcement. To know more about the work of the Kuwait Public Policy Center, kindly visit us on our new website, kppc.scpd.gov.kuwait.kw. Apologies. Thank you for your attention, ladies and gentlemen. May you have a good night.
Thank you very much.
Thank you for the invitation. It was a pleasure.
Thank you.
Thank you.